Welcome to This Explainer. Today, we're setting up a pretty stark contrast. We are going to look directly at Wall Street's flashy, get-rich-quick illusions, and we're going to compare them to the quiet, timeless blueprint of true wealth building. So if you've ever felt completely overwhelmed by the relentless noise of the stock market, you are in the exact right place. We're going to strip away all that hype, and we're going to focus strictly on what actually works.
But to kick things off, I want to ask you a question that might seem, well, a little surprising. How could one of history's greatest scientific minds, a guy who literally figured out the laws of gravity, suffer absolute financial ruin in the stock market? Okay, let's dive into this. Back in the spring of 1720, Sir Isaac Newton owned shares in the South Sea Company. Now, this was the hottest stock in England at the time. He actually made a massive 100% profit and got out. Good for him, right? But then, swept up by the wild enthusiasm of the crowd, the classic FOMO hit him. He jumped right back in at a much higher price and lost £20,000. To put that into perspective, in today's money, that is over $3 million. He famously muttered that he could calculate the motions of heavenly bodies, but not the madness of the people. And honestly, this proves a really vital point. Having a high IQ absolutely does not prevent financial disaster if you lack emotional discipline. So to avoid a fate like Newton's, we have to turn to the ultimate blueprint. Enter Benjamin Graham. His masterpiece, The Intelligent Investor, which was recently updated with some brilliant commentary by financial journalist Jason Zweig, is widely considered the single best book on investing ever written. It's basically the gold standard guide to protecting yourself from the madness of the markets. Throughout this explainer, we're going to use Graham and Zweig's insights to completely rewire how you view your money. Section 1, The Speculation Trap. Wall Street Solution. To really grasp the brutal reality of a speculative market, think about this number for a second. 95%. By the end of 2002, right after the wild dot-com boom of the late 90s, many heavily hyped technology and telecom stocks lost an astonishing 95% of their value or even more. I mean, decades of wealth were literally vaporized, simply because people forgot to ask one basic question. What is this business actually worth? And here is the terrifying math behind that kind of ruin. If you take a reckless risk and lose 95% of your money, it's not just a minor setback. To get back to where you started, you don't just need a 95% gain. No way. You have to gain a staggering 1,900% just to get back to zero. This is exactly why avoiding catastrophic loss has to be the very first rule of wealth building. You know, the late 90s really captured the absolute peak of this frenzy. Just consider the average length of stock ownership back then. We're not talking years, we're not talking months, we're talking days. For companies like Puma Technology, shares changed hands on average every 5.7 days. The market had been completely decoupled from the actual businesses. It turned into this frantic national video game where the underlying value of the company was just entirely ignored. Jason Zweig actually offers a brilliant analogy for this kind of speculative frenzy. Imagine you need to travel 130 miles. You could drive the speed limit at 65 miles per hour and get there safely in 2 hours, right? Or you could drive 130 miles per hour and get there in 1. If you try that second option and somehow survive, does that mean your strategy worked? Of course not. It just means you got incredibly lucky. Surviving a reckless strategy in the short term does for sure not make it a sound long-term investment. Section 2. True Investing. Graham's Blueprint. Benjamin Graham cleanly breaks down his definition of an investment into 3 non-negotiable steps. Number 1, thorough analysis of the company and the soundness of its underlying business. Number 2, you must deliberately protect yourself against serious losses, ensuring the safety of your principal. And number 3, you aspire to an adequate, not an extraordinary return. Notice how this completely shifts the narrative. We're moving away from frantic gambling and moving toward controlled, deliberate ownership. So the absolutely crucial point here is this fundamental difference in mindset. An investor calculates what a stock is worth based on the underlying value of its actual business operations. A speculator, on the other hand, they're basically just gambling that a fluctuating price quote will go up just because somebody else is going to pay even more for it. Graham urges you to only buy a stock if you'd be perfectly comfortable owning it, even if you had literally no way of knowing its daily share price. Section 3. Beware magic formulas. Shortcuts to nowhere. Let's see how this builds on our understanding of speculation. Back in the 1990s, a money manager named James O'Shaughnessy published a book claiming he had this foolproof automated strategy to beat the market, all based on historical data. He even patented the thing and launched mutual funds based on his findings. But here's the harsh reality. As soon as those funds launched, they drastically underperformed the standard S&P 500 index. It turns out, when heavily publicized mechanical formulas are exposed to the real world and everyone knows about them, they fall apart fast. Or take another trendy 90s strategy, the so-called Foolish Four. It promised you could crush mutual funds with just 15 minutes of work a year. The formula? You take the 5 Dow stocks with the lowest prices and highest dividends, then you discard the very best one, put 40% of your money in the second best, and 20% in the rest. Let's apply Graham's test here. Dropping the best priced stock? That is definitely not thorough analysis. Putting 40% of your money in one single asset? That severely lacks safety of principle. Honestly, it's just absurd to risk your hard-earned wealth based on random mathematical flukes.
Section 4. The Inflation Illusion, Macroeconomic Myths.
Now we have to tackle the burning question on every investor's mind. But doesn't inflation just ruin everything? Traditionally, Wall Street loves to tell you that stocks are the ultimate built-in protection against inflation, like they're supposedly guaranteed to outpace rising consumer prices. But Graham's counterintuitive historical data reveals a very, very different story. When Graham looked at historical comparisons stretching from 1915 all the way to 1970, he uncovered a really surprising truth. During periods of massive inflation, the actual earning rate on capital shown by American businesses did not advance alongside wholesale prices. The inflation didn't somehow magically inflate stock values or boost corporate equity earnings. It turns out the gains in the stock market were actually driven by reinvested profits over time, not by inflation acting as some magical tailwind for growth.
And this brilliantly illustrates exactly why corporate profitability didn't just skyrocket during those inflationary decades. Between 1950 and 1969, while wholesale prices advanced nearly 40%, corporate debt expanded nearly 5-fold, while actual profits before taxes only doubled. These companies were taking on massive amounts of new debt just to operate. Those huge debt burdens largely offset any illusion that inflation was organically supercharging equity growth. It is a really sobering reminder that macroeconomic trends rarely translate directly into simple stock market profits.
Section 5. Your Worst Enemy. Investing Psychology. This might just be Benjamin Graham's most profound realization of the whole bunch. The investor's chief problem, and even his worst enemy, is likely to be himself. The absolute greatest threat to your financial future isn't a sudden market crash, it isn't inflation, and it's certainly not a bad CEO. It's your own lack of emotional discipline. It's that tempting urge to follow the crowd, to buy high out of greed, and to panic sell when things get scary. Just remember Sir Isaac Newton. Ultimately, how your investments behave is way less important than how you behave. So I'll leave you with this lingering, somewhat provocative question to take away from our explainer today. Are you ready to stop playing the casino and start actually owning the business? The blueprint for true wealth is right here in front of you. It requires patience, it requires discipline, and a deep focus on intrinsic value over those flashy, blinking price quotes. If you abandon the hype and embrace the mindset of a true, intelligent investor, you won't just survive the markets, you will absolutely master them.